I would like to first request our speaker for the day, CA Venkata alias Rahul, onto the dais, please. Please give him a warm round of applause. I request all the delegates to please stand for the ICA motto song. Very good afternoon and good evening to one and all present here. I welcome you to the study circle meeting on direct tax. We have specifically chosen this topic as capital gains and specifically the issue of 50C and 43CA of the Act. And we have seen increasingly, we have been planning programs for the benefit of practicing members and practical issues. We had a program on ITR filing recently. We are planning on having a program on tax audit. As I announced in the last program, we are currently in talks to have somebody from the CPC of the income tax also come and address us for practical issues pertaining to CPC. We all know that today we are getting notices arbitrarily saying that your refund has been adjusted against your demand pertaining to assessment year 2002-3. Well, they cannot reopen beyond 6 years, but using this loophole, they are trying to adjust, saying your refund has been adjusted. Obviously, neither us nor the client maintain the data regarding assessment year 2002 and 3. So in these sort of practical scenarios, how do we handle it? Why are there gaps in the income tax side? It could be because TDS is not deducted by the employer at that point of time, but it has been deducted from your salary. Maybe it is not remitted properly or not filed properly. Owing to these challenges, people are having their refunds adjusted today or not even being issued today. So in this backdrop, we felt it important that practicing people should have a chance to understand how to resolve CPC issues and also understand why CPC these issues are coming up in the first place. So this is our plan for the next month and a half. It was pushed because the extension date had come, rightly so. We all know in the ITR filing session also we discussed extensively how ITR 2 and ITR 3, that one irritating schedule, section 112A, has come in where they expect you to list down each share that has been sold by the SSE with their ISIN number, what was the purchase price, name of the share, sale price, what was the highest value on 31st January 2018. So all these details they were expecting, and their extension has come due to multiple reasons, including that we all know for Form 16 itself, the date was extended from June to July. So most companies gave their employees the Form 16 only towards the end of July. So practically complying that 31st July date was difficult. And so the CPC program and the tax audit program has also, we have pushed it a little bit to allow people to comfortably file their returns first. But this issue pertaining to 43CA and 50C is an evergreen issue. No matter whenever we have multiple capital gain seminars, this issue seems to always constantly be there because it's a tricky issue. 50CA has also come now with a similar model to 50C. But why is 50C such a critical issue? Our speaker will also touch upon it, but we can imagine certain scenarios where the chant value is decided, the guideline value, whatever is there as per the state law, is existing. Your consideration, let's assume, is lesser than that, 40 lakhs consideration, but guideline value is 50 lakhs. Then you have to take 50 lakhs as the sale consideration as per the Act. That we all know. But let us come to scenarios such as section 54 or 54F. In 54F, you have to reinvest the sale consideration. So when they say sale consideration, do they mean 50 lakhs or do they mean 40 lakhs? Because you have only received 40 lakhs, you have not received 50 lakhs. 50 lakhs is a notional value determined by law, it is by Act. It is not the actual consideration you have received. So does the income tax expect you to invest more than what you have received, or do they expect you to invest only what you have received? So these are some aspects apart from others in 50CA and 43CA and 50C that our speaker will touch upon. And we have a very, very interesting and excellent speaker who will be touching on this topic. He has come all the way from Rajamundry. He was also a committee member last year in the subcommittee of direct taxes and few other committees as well. And he's a good friend. He's a teacher, he's very dynamic, and I will formally read out his profile. CA Venkata Narayan Vedantam, that's his real name, but he prefers us to call him Rahul. So I'm used to calling him Rahul. Every time I have to read his full name, I have to look at the word. So he is a chartered accountant and he qualified in 2001. He's a graduate of commerce from Andhra University and a postgraduate of law also from Andhra University. He's a postgraduate diploma holder in computer application. He was the president of the Junior Chamber of International Commerce in India for the years 2018-19. He is also a member of the Financial Committee for 2017, 18 and 19, and he is also a JCI trainer. He has trained the police department, corporates, lion leaders, top and medium level management of corporates, teachers, lecturers, etc. He is a faculty for speechcraft and chairmanship and parliamentary procedures. He specializes in relationship management and he is a regular teacher in GMCS and various ICAI branches. He has authored many training manuals and many books also, several articles pertaining to income tax and GST, and he has won these special awards. Director and faculty of the Sri Medha Educational Institutes. He is director of Jampeta Cooperative Urban Bank Limited in Rajamundry. He is a governing body member of the Government Art College and the Government Degree College of Thuni. Zone chairman of the Lions Club, faculty for the Andhra Pradesh Cooperative Urban Banks Federation, and regular leadership in any programs that you can see, ICA or any corporate that happens extensively in Andhra Pradesh or Tamil Nadu. He is very actively involved. He's a wonderful speaker, and just listening to him is a real pleasure. He's a very nice, down-to-earth person, and he's regularly addressing on various income tax topics also, which means he trains at the department, and in fact, this very session that he is taking today, he took it with the Principal Commissioner of Income Tax just a couple of weeks back. So we're very lucky to have him on the very hot topic to be here today and discuss it with us. So with this brief profile introduction, I'd like to welcome our speaker of the day, CA Rahul, onto the dais. Please give him a very, very warm round of applause. The stage is yours. Before our speaker starts the presentation, we would like to present him with a token of our love and affection, a small memento.
Good evening, Abhishek, and good evening to all the chartered accountants present here. Thanks for the introduction as well. Two things scare me, Abhishek. One is the color of the hair. Second is what is inside that hair. So I see that all are seniors here, and this is my maiden venture at this level at SARC premises. So hope I am starting off, with an asterisk mark saying that this is my maiden venture. Friends, I will just take you across every point we have divided this session primarily into two parts. One is 50C, the other is 43CA, dwelling more upon 50C. In 50C, the course, I've designed it as one, we understand the law. Okay. One, we understand the law and the key terms. Second, we analyze the various terms of terminology provided in section 50C. Third is the various judicial pronouncements that I was able to compile from orders of various tribunals and high courts. And this material would be given to you. Whatever is displayed here, it would be given to you. Especially the case laws part, we have compiled it into a Word document which will be shared with you as the participants' material. So with this, we start off with the first part, that is introduction in law. So we all know the charge to tax. This is under capital gains, and we all know that charge to tax is under section 45, and the full value of consideration is under section 48. So under section 45, whatever is highlighted here, whatever is put in bold, these are the crux, these are the important terminologies of this section. That is why I have put them in bold. One is the transfer of capital asset. Under section 45, the transfer is important, and now under 50C also, what is transfer, that is also very important. And under section 48, under 45, it is the charging section. Under section 48, it talks about full value of consideration. In short, we will be calling it FVC during this program. The full value of consideration received or accruing. We already know section 45 and section 48 on that presumption. However, recollecting it shortly in brief, we are just going ahead with this. So the charge to tax is under 45. However, the full value of consideration that is to be taxed is under section 48. Now, this is a specific provision. This says section 45 says what is to be taxed, and section 48 says how it is to be computed. And now we go into the preamble of the introduction of 50C, which shortly we will go into. 50C was introduced because there were increasing real estate transactions, and during the course of increasing real estate transactions, there were two major points. One is government was losing revenue. Second point is the state governments were losing stamp duty. The third point is there was so much of cash that was being carried and cash being handled by the parties, because of which a parallel economy was being strengthened because of such transactions. So therefore, it was necessary to curb, to increase the revenue, to curb the tax evasion, and also, to curb the practice of carrying the cash and thereby not accounting for it. 50C was introduced in the year 2003. We know that there is already existing huge difference in the sub-registrar office SRO, this sub-registrar office value and the market value that exists. Today we buy a flat or an apartment for say a crore of rupees. Real value is crore of rupees, market value. However, we get it registered only for 60 lakhs or 70 lakhs. Thereby there is always this gap, which finally economic wise, if not fiscal, economic wise, it leads to inflation also. So there is already existing difference, and transactions out of books in cash resulting in black money, also in tax evasion, also in less stamp duty to the state governments. So this being the preamble, we are going ahead into section 50C, understanding the preamble so that we stay connected to the intention of the legislature. Consequent effects of inflation also, as we just told. So this is as a measure to curb the tax evasion and also the flow of cash. Recently flow of cash, it is being strengthened at every phase. And this point, just stopping here for a while, we understand that most of the sections in the Income Tax Act, whenever there is a new section, it operates effectively at least for 5 years. And then the system brings out system gives good ideas uh, to the SSCs and to all of us also. Because of which after 5 years, the legislature is forced to bring out another section. This is, so 50C is the consequence of, knowledgeable people. So now 60C, it is special provision for full value of consideration. Actually, full value of consideration has to be adopted. Full value of consideration is defined in section 48. However, this is only in specific cases for specific circumstances. Specific enabling provision has been incorporated as 50C. So the entire text is there. However, the highlighted parts are important for our discussion because this is not a new section and it already exists. However, the highlighted parts are the points of discussion today. Where the consideration received or accruing, consideration received or accruing. So it deals with the accrual also, not just the consideration that is received. As a result of transfer, now we know the definition of transfer. We will get to that. However, we need to understand the definition of transfer also. By an SSC, so who all are covered under this section? That point is taken care of when we go through the definition of SSC. Of a capital asset, now we know the definition of capital asset also. That is also there. Capital asset is defined for the purpose of capital gains. So specifically that capital asset being land or building or both. Now 50C having come into existence to curb so many things. However, this has been restricted to land, to building or both. Now we should understand when before land or building or both the word capital asset is used. The land or building or both have to be read, in as an addition to the capital asset. So land, building or both that are capital assets only are taxable under section 50C. Those which are not capital assets cannot be taxed. Like for example, land which is not a capital asset cannot be taxed. We know which land is not a capital asset. Is less than the value adopted or assessed or assessable by the state government authority. Suppose the consideration is less than the value dash 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 shall for the purpose of section 48. Now here it says full value of consideration. We just understood that it is already there in section 48. Now full value of consideration for the purpose of that section only this is given. So this is not independent. It is helping section 48 in this specific case. Be deemed to be the full value. See, deeming. Our law is totally of deeming fiction. So many. Every year, so many things are being added to the taxation law. It is more like, being other than being very accurate, it is more by estimation only that it is happening. So this is another deeming fiction that came into existence. Be deemed to be the full value of consideration received or accruing as a result of such transfer. So these words, the consideration, transfer, capital asset, land, building or both, purpose of section 48 and deeming, all these are the important words that need to be understood because the litigation rests more with these terminologies and the interpretation of these terminologies when it comes to practicality. So this is, and before I scroll on to the next, Abhishek, I will share with you something else also. Something else that scares me is, people looking very seriously. So, yeah, thank you for that smile. So the keywords that we could compile, we just went through. The keywords are received or accruing, right? Transfer. I just put in the definition here only in short so that we can just recollect in the context of 50C. Transfer 247, it is sale, exchange, relinquishment, extinguishment of rights or compulsory acquisition, exchange, conversion to stock in trade, etc. 247 encompasses all this. So in short, it is given there for a quick recap. And SSC, any person is an SSC, any person who has to pay tax or who is deemed to be in default. All these people are defined in section 2.7. So SSC for the purpose of 50C everybody is covered. It is not limited to few. Like for an example, 56 to 10, which is recently come in the place of 56 to 7. There it is limited to individual or HF. So here there is no such restriction. It applies to all SSEs. Right from who are all SSEs, and the definition of person is also given in 231. We are aware of that. So capital asset. We were talking of the capital asset and personal business property, stock in trade, personal effects, specified agricultural land, etc. All these, are they capital assets? They are not capital assets. So capital asset encompasses personal or business property. However, not covered are the stock in trade, personal effects, specified agricultural land within 2, 6 or 8 kilometers, etc. They are all not covered, and there are a few government bonds also that are not covered in the word capital asset. So personal or business property, both are covered under section 50C. So for example, we have an SSE who is the proprietor of a concern, and he sells his land, which is a business asset. So that is on one hand. Then on the other hand, he has got individual books of accounts. He maintains personal books of accounts, and from out of that he sells a land. So there is this difference, and this difference also we will get to understand more as we get more into this, because when it is a business asset, would it be taxed under this section? Should it be charged under 45, or is there any other section? Or is there section 28 to take care of business asset? Or is there section 50 to take care of, the value of the business asset, etc.? That also we will get to understand. Okay, so capital asset for the purpose of section 50C, it means any personal or business property. And it does not include stock in trade. Which means that as we go along, we also have to understand that 50C is not applicable to such properties which are chargeable as stock in trade. So if they are current assets, they are not chargeable. If they are fixed assets, they are chargeable. Because later on, because the topic we spoke of 43CA also. In 43CA, the stock in trade has been incorporated. So it does not cover that. And fair market value also is a word that is used in section 50C. Fair market value is nothing in simple words. It is the readily realizable value in the market. There is nothing more in that definition to understand. Now, we also have to understand that in section 50C, whatever is a transfer, it is covered in 50C. However, what are not capital assets, what are not transfers, they are not covered. So, what are not capital assets, we have just seen. That stock in trade, etc., personal effects or specified agricultural land, etc. And what is not a transfer also is not covered under this section. Now, what is not transfer, we need to just relink our mind to section 47, where transactions are not regarded as transfer, which means to understand why that in section 47, partition or settlement, they are there in section 47, which means that such transactions are not transfer because of 47, and for the purpose of 50C, because they are not transfers, they are not covered in 50C. So that perspective, we are just linking ourselves or relinking our knowledge to all the required sections here. Now this is section 50C, as we have already seen. However, there was an extension later on, and there was addition to section 50C with effect from 1/4/2017. Now, there were practically so many number of cases, people suffering, because in certain cases, in certain states or in certain cases, the stamp duty value would be unreasonably high, because the state government might want revenue. And this is a state law. Stamp duty is a state law, whereas section 50C is of a central law, where the central law was linking its tax to a state law. They both of them to go hand in hand, it was becoming difficult, and because due to which the valuation issues were arising in few places especially. So for which the department was the legislature was forced to incorporate a breather for the SSCs, and these are the provisos. Whenever to a charging section or to a computation section there is a proviso, we know that it is a relief to the SSC. So these are more like reliefs. Provided that where the date of agreement fixed. So date of agreement is one word. We already must be knowing that. Over this we will go a little in detail only, because that came in 2003. The section came in 2003, whereas they were added recently only. So we must not have encountered really few cases in scrutiny. So provided that where the date of agreement fixing the amount of consideration and the date of registration for the transfer of capital assets are not the same. Now we made an agreement 3 years ago when the stamp duty value was, say for example, 10 lakhs, and now the stamp duty value has increased to 15 lakhs. However, the builder has handed over, or we got the property registered today only. So now it has to be registered at 15 lakhs, whereas the actual consideration is 10 lakhs. The intention in the preamble, we saw that it was to curb the flow of cash. Here there is no flow of cash, still people are suffering. Multiple such cases coming into light, this was incorporated as a breather. The value adopted are not the same when it is 10 lakhs and 15 lakhs, when it is not the same. Value adopted or assessed or assessable. So many words are put. Value adopted by the stamp valuation authority, or assessed, which means that it is put in the document, or which is assessable, which means that at that rate it is assessable, and there might be, the transfer might be pending because of certain circumstances, or because of disputes, or because of disputes, in which cases the word assessable also is used by the stamp valuation authority on the date of agreement. So for this purpose, where the date of agreement is differing, date of agreement, date of transfer, the values are differing, then the value to be adopted is the value as on the date of the agreement. That is, in the example that I gave, what we have to adopt is not 10 lakhs, what we have to adopt is not 15 lakhs, and it is 10 lakhs. However, this is subject to another rider, another provided further, another proviso is added to this, and it says provided further that, which is an addition, which means that further means that we have to comply with this condition also to get the benefit of the proviso 1, we have to comply with proviso 2. Proviso 2 or provided further says that proviso shall apply only in a case where the amount of consideration or part, where the amount of consideration or part in this has been received by way of other than in cash. So by way of account pay check or account pay demand draft or electronically ECS facility, NEFT, RTGS, or through bank account on or before the date of agreement or for transfer, which goes to show that if on the date of agreement it is 10 lakhs and it is 15 lakhs on the date of transfer, any portion of the consideration, if it were received through any of these modes that are specified, 3 modes are specified, they did not use the word other than in cash. Other than in cash would have encompassed exchange of asset also. So here they specifically used account pay check or account pay demand draft in these 3 modes. If it is not these 3 modes, then the benefit of proviso 1 cannot be taken. So earlier, either the date of 3 years ago when we made the agreement, either on the date of agreement or before the date of agreement, amount should have been given to account pay check or account pay demand draft, or the third mode, that is ECS facility. Now this leaves us open to few discussion on few topics, few points. That is, when we can see that amount of consideration or part thereof has been received. So this part is not specified. So part can be anything. This part amount can be anything. Now, part if it were realized through account pay check, then the benefit of proviso 1 can be taken. Now, as we connect to the books of accounts, as we connect, there may be few. This I'm not talking out of the law. There may be few instances. There may be few instances where we are doing multiple transactions with the same person. In those multiple transactions, we must have given checks for some other transaction also. We must have given an account pay check for some other transaction also. Right? Not only for this. Out of which we can think of, how to implement this, how to take benefit of this section. Now, by way of account pay check or demand draft, they say it has been received, the consideration has been received. So it leaves us open to another point of discussion, that because it is not specified that the check or the DD should have been encashed or realized. It is not spoken in this section that it should have been realized. Now how do we get about with that? Or go about with that? That is also one point of discussion. However, see, the very essence of section 50C would be distorted if we extend our logic to such weird situation. So it is a presumption that it should have been encashed. So that presumption was, I did not come across any case law where this presumption was held. However, we rightfully presume, I feel that account pay check or the demand draft should have been encashed, or else the very purpose of 50C would be, Now another change to this section with effect from 1/4/2019. This is a very, very small relief that is given in terms of if the 10 lakhs to 15 lakhs value is, if for 10 lakhs, there is not, the change is not by more than 5%. Like for example, for the 10 lakhs date of agreement value, if the stamp duty value increases to 10 lakh 50,000 or 10 lakh 49,000 or 10 lakh 40,000, then as per 50C, actually 10 lakh 40,000 only should have been adopted. However, not more than 5%, then that small leverage is given. Now, with the incorporation of this proviso, which says that 105% if the change does not happen, then with effect from 1/4/2019, the incremental value need not be considered, date of agreement value only can be considered. This is not really a great relief, however, it is a small handy one, that's all. So, this exists. I think we have to switch on. Yeah, thank you. So this is, this is one part. Okay, good. So, now we come to the point, what if the fair market value is less than the sub-registrar office value? The fair market value is less than the sub-registrar office value. Then under 50C2, you make a claim before the assessing officer, asking him to refer to the valuation. Now comes a point, here make a claim. In the act it is said that you have to make a claim before the assessing officer. Now the question that crops up, what if the assessee did not file his return? First point. Second point, what if it was not selected for scrutiny? What if it was not selected for assessment? The assessment is not in process. So these questions also have to be answered here, because it says make a claim before the assessing officer. The reference to then after you make a claim, only then valuation can be, only then it can be referred to the valuation officer. Valuation officer, departmental valuation officer, we know the provisions of wealth tax apply in such a case. Yeah, got it. Thank you.
It is not taken up for scrutiny. What is the position of the assessor?
Yeah, slowly we will come up with few questions, and that we will discuss. However, if it is not taken up for scrutiny, and that situation Did we file our return or not? First question. Second question, did we file our return adopting 10 lakhs or 15 lakhs? If we voluntarily admitted 15 lakhs, the question of valuation will not arise. If we adopted 10 lakhs and there is no scrutiny, the question of reference also does not arise. So that is both the situations. In either way, we get to benefit, out of this. And however, 148, there is always a scope. And so make a claim before the assessing officer. Assessing officer, the act says that assessing officer may refer to the valuation officer. So here in this few courts, I will pass on the judgments also. Few courts have held that, assessing officer, though the word may is used, may shall be read as shall. So it is mandatory for the assessing officer to refer it to the valuation officer in the case of dispute. In the case where SSC contends, or in the case where there is a variation. Even if the SSC does not contend also, it is his duty, because he is adopting some value which the SSC did not disclose in his return, or which the SSC did not realize. Because where consideration is realized, that only on that part only the department can levy tax. Anything beyond that, the department has to prove that its value is higher and there is some income that escaped assessment. So therefore it is mandatory. Over the wordings used, assessing officer may refer to the valuation officer. Okay. And that is the situation of, this one is the situation of fair market value being less than the sub-register office value. Now situation, what if fair market value is more than the sub-register office value? There can be a circumstance when it is more than the sub-register, but then the valuation that is taken. So in such a case, the sub-register office value only has to be adopted. And in that case, like for example, 10 lakhs is the agreement, 15 lakhs is the sub-register office value as on the date of transfer. After referring it, the valuation officer has given it at 18 lakhs. Now, should we take 10, 15 or 18? So law says you take 15 only. So 50C says you take 15 lakhs only. Not if it is higher, if the DVO's, Departmental Valuation Officer's value given is higher, then need not adopt that. The SRO value itself is the full value of consideration for the purpose of section 48. So this is the reading of the entire law that exists. So as we divided this into three parts, one is the law and various contents that are connected with section 50C. The second part we now go to the analysis. We were just going through few important terms and we go through the analysis. Now the important points, we will take this up as part of discussion, so that so that any people who have encountered seniors who have encountered come across situations practically which deal with these points, you people can also be pleased to throw some light on it. Application of 50C to partnership asset introduction as capital. When capital is introduced, when an asset is introduced by a partner of a firm as capital into the books of the partnership firm, the question is, would 50C apply? No, I turned it off. Okay. So, if an asset is introduced into a partnership firm as capital, which is recorded in the books of accounts as capital, introduction as capital, not recording, is one circumstance. Right? The firm continues to use it. Possession control is there. However, it is not transferred in books. That case you are not talking of. We are talking of a case when it is introduced as capital in the firm. Then would section 50C apply?
No transfer.
Pardon, sir?
It will come into transfer. Must to attract 50C.
So, sir, for this purpose, there is already 45.3, which says under 45.3, see, this is one deeming provision. 50C is one deeming provision. 45.3, another deeming provision is there, in which I will just read out 45.3, the relevant points I will just read out from 45.3. Then it is then we get to understand it straight away. In 45.3, the profits or gains arising from transfer of capital asset by a person to a firm in which he becomes a partner by way of capital contribution. I'm just cutting few things. By way of capital contribution, such shall be chargeable to tax as is income in the previous year in which such transfer takes place. That is okay. 45.3. From there on, and for the purpose of section 48, this also for the purpose of section 48. The amount recorded in the books of accounts of the firm as the value of capital asset shall be deemed to be the full value of consideration. So there is another specific deeming provision for such a transaction. This is a general deeming provision. So when there is a specific deeming provision under 45.3 which says that full value of consideration, what is deemed to be as full value of consideration for 48 is whatever is recorded, then 50C cannot apply. So therefore, in such a situation, 50C will not apply to the cases where asset is introduced by a partner as capital and which is recorded in the books of accounts. So another situation, 54 section 54 exemptions, series of 54 exemptions are there. Can they be granted for 50C value or only for the consideration received? This is another question. First of all, before going into that question, 50 can we take if 50C is applied and tax is levied, capital gains are computed on 15 lakhs. Now, section 54, would it apply only to the extent of 10 lakhs or to the extent of 15 lakhs?
10 lakhs. 10 lakhs. Otherwise, what will happen? They will charge 50C separately and 5 lakhs they will say unexplained under 69 also. So the thing is, what is actually received? The apparent consideration alone can be invested. Then only as is in a safer position, and that is the law.
Okay, that is the law. Oh, yeah. Thank you, sir, for sharing your views. There are few cases which I would be sharing with you, which are to the benefit of SSC. They say that the total when it is taxed, the total amount that is 15 lakhs, that investment benefit can be taken. That is one point. Another point which you incidentally made under section 69. There are case laws now which I would be sharing, which say that section provisions of section 59, section 69 are specific, and this deeming over that deeming cannot happen because this is a deeming provision, and so the 69 series under 50C, that 69 series would not apply. That is also there. So these two also I will share. It might come handy. They are, I think one is Ahmedabad tribunal judgment, and they can come handy in our cases. So whether 54 exemptions can be granted for 50C value for or only for consideration received. 50C value is 15, consideration received is 10, so they can be granted up to 15 lakhs. There is a judgment which I will share with you.
May I add a point here?
Yes, sir.
So there was a decision, I think, Karnataka High Court, Gauli Mahadevappa, where it has been held that what should be reinvested. Now, question came up under section 54F, where they said, as I already quoted in my opening address, you sell a land for 40 lakhs. 50C deems the value to be 50 lakhs. Now you want to reinvest under section 54F. Question comes up, how much should you reinvest? Act says you have to reinvest sale consideration. Sale consideration is 50 lakhs. But actually what you have received? Only 40 lakhs. Now you have to reinvest as per Gauli Mahadevappa. There might be some other decisions that Rahul will enlighten us on. But as per this, they say you have to reinvest the entire 50 lakhs, whether you have received it or not. But now there are some other contradicting decisions where it says you can reinvest only what money you have got. You can reinvest only what money you have got. You cannot borrow and reinvest. It has to be the same thing. Now, logically we will question that because section 54F came at a time when cash transactions, this 269 ST was not there. You could buy an entire property using just cash. So they are saying you have to use the same money. So what they expect, whatever money you are getting, cash money you are getting for the property, you have to take it, keep it in that locker. And when you are reinvesting that same bundle, you have to take out, they're expecting. If you say, I took the next bundle, you should have taken that bundle, you missed out. Like that they will say. So they're expecting that logically what they are trying to say is that same money, only you should reinvest. You should not, you cannot borrow and reinvest. There are some decisions like that also. Where practically when it comes to this section, especially section 50C, when you have not even received that money, and they are saying you have to reinvest what has not been received, naturally you have to only borrow or use your own sources. You cannot use the sale consideration received from the sale of that property because it is inadequate. Now these are certain important questions that are still not answered clearly. There are multiple contradictory decisions. In fact, at the Chennai ITAT, there was a Delhi judge who was very strongly, vehemently saying you cannot borrow. And I was saying, Lordship, it is impossible for me to comply with section 54F unless I borrow. I cannot reinvest the entire sale consideration unless I borrow, because the sale consideration is only higher by deeming. If, for example, I have a land in Nunambakam High Road, opposite the CA Institute, it is a triangular property. It is not properly shaped. Every person I have rented it out, somebody has committed suicide in that land. So there is some fear to that value. If you take guideline value of Nunambakam, it will be very high. But the actual property value will be much less. So I may sell it for much lesser than the guideline value. So in these scenarios, I cannot reinvest what is the guideline value. I cannot reinvest the fair market value as per the state guideline value. So these are certain questions which are still remaining unanswered under this section. Sorry Rahul, I thought I should pertinent to point that.
Yeah, thank you much for that. In these are the points of discussion, various points that come up, and there are decisions either ways. So decisions that can help us, those decisions I will be sharing, rather than always decisions which will not help us. There is really no point, because however we would always search for them. So handy decisions only I am sharing. And thank you for the inputs. And Gauli Mahadevappa case, as Karnataka High Court in 2013 judgment, that is rightly applicable to this point. Whether the deeming fiction would apply to 69, 69A, 69B, there are judgments that it would not apply. So we need not worry about that really, because it is already being taxed here under 45. So whatever is being taxed under one section, the charge to another section cannot happen. Can we record the full value of consideration, actual consideration as cash received in books? I will restate the question with that example. Can we record 15 lakhs as cash received in the books? Because however we are paying tax on 15 lakhs. Can we do that? Actual received only we have to record in our books. Anything beyond that we have to explain, or else we get exposed to the risk.
It amounts to wrong entry.
Yeah, it amounts to wrong entry. It can even amount to section 69 also can get attracted in such a case if we record. However, recording in books and offering in the income tax return both are independent of each other. That way, while preparing the books of accounts, there are in Mofussil place. I come from a Mofussil place, which is a small place, Rajmandri. In such a place, they would always want to. The understanding is at that level that they want to tally the income tax return in the books of accounts. That way they prepare the books and bring to us, after which we have to sit and make few corrections, understanding the law and making them understand that both are independent. Now, having spoken of that point, I will just drift a little. It has become even more difficult, especially with the GST in force for the GST 9 returns which we are filing, because the books of accounts have to tally with GSTR 3B, they have to tally with GSTR 1, they have to tally with the 2A, whatever claim is visible. That fellow is booked as B2C, B2B, we don't know, whatever is visible. And then we have to further again check with 1819 books of accounts and 1819 3B, because some transactions that were not recorded in 1718, whether recorded in 1819, or some transactions not disclosed in 3B, GSTR 3B of 1718, whether were disclosed in 1819. It is such a huge process tallying with everything. I don't know if you are getting any service tax notices here. Service tax notices everywhere. In our place, service tax notices are just being sent like love letters to everybody. for the reconciliation, and that makes it more worse. When the reconciliation not only with turnovers but also with tax has to happen. Unfortunately, like how it is in the income tax, we have the assessment year on the tax paid challan. There is no assessment year or the financial year in the service tax challan. So the same challans are shown, and we have to reconcile, so many challans. And now we are doing the task of reconciling 10 years challans. 10 years, right from 2009. We don't know what we are doing. So, actual consideration, no. It is very, very risky. We will not advise on that. Can section 50 apply to cold storage building? Just one example I took. Can it apply to cold storage building? Yes, no, yes, no. No, we will see whether that is.
Cold storage building as such can be classified as plant and machinery too.
And plant and machinery too, correct. So, even otherwise, if cold storage it is being used, what you said is correct. Even otherwise, it is a depreciable asset. So when it is a depreciable asset, it is covered under some other section, not required under 50C. So just for that, discussion, I put this point.
It is registered as immovable property.
It is undoubtedly it is an immovable property only. The word immovable property is not used anywhere in this section.
No. When it is registered, registrar will apply 50C guideline will. Stamp duty value will be more.
It will certainly be more only because our written down value in the books would be less. We would have provided depreciation and it would have been very less, naturally. And that difference is taken care of in the depreciation schedule of the income tax computation only automatically, which would ultimately result in either short-term capital gain or short-term capital loss under 50. Ultimately. So this question of 50C will not arise there at all. When an account pay check is received and not encashed, this is we just spoke of that, right? It may happen that it is not encashed. Unfortunately, the advance given sometimes is very, very less. We have this figure of 9, fancy number of 9. So sometimes they give 9,000, or sentimentally they give 11,000, or they may give 999 rupees check. Something like that, which in fact, because it is a small sum of money when compared to the, value of the asset. There might be situations when really it must not have been deposited. Then still, it is because it is not encashed. Even if it is for a genuine reason and no tax planning involved, still, we cannot take the benefit of proviso 1, and we have to pay on full value of consideration. That is under 50C. The full value 15 lakhs we have to pay. Which value should be adopted in partition settlements?
DD is taken.
Pardon, sir? Pardon?
Instead of account paying, if they have taken the DD.
Account pay check or DD, this is one example. In that section, account pay check, account pay DD or ECS are the 3 methods.
DD if you have taken, then I have discharged my liability. When you are not depositing it and then not taking it.
Correct. So, to take the benefit of it, you should have received it. If you have not encashed it, then you have not taken the consideration. You have not taken part consideration, then we cannot claim the benefit. See, the very purpose of, that is why we went through the preamble also. Very purpose is to mitigate such transactions. And when when a check is not encashed, the purpose of 50C gets diluted. So there is.
Similarly, check is dishonored also.
Check is dishonored also. Yes, correct. It should have been encashed is the understanding. So it should, if it gets dishonored, then naturally that attempt, I have not come across such a case. I can only assume like you. I have not come across, but still I think we can rightfully assume that it should have been encashed. Sir?
Check is given, it is payment in due course. So payment in due course.
Correct.
As per negotiable.
Correct, sir. And for this purpose, this specifically it is there that it is received. So received means not check instrument is received. So received means the consideration is received. We cannot, interpret it as check received. We should interpret it as the consideration received. Consideration is received only when it is encashed. So that way we cannot stretch our imagination and take the benefit of proviso 1 and run the risk of not using section 50C2 for evaluation. Contending on that ground, we lose the shelter of requesting it for evaluation. Why to take that risk? So that is my opinion. Which value should be adopted in partition settlements? Partition settlements happen, in that partition deed is written. So which value should be adopted?
Only case of nominal
So,
value.
Nominal value, SRO value.
sir,
So do they fall under section 47? They fall under transactions which are not considered as transfer. So here section 50C deals about transfer cases, not transfer cases. Right? So the question does not arise. So in this case, which value should be adopted? Where the question of adopting a value does not arise because 50C does not apply to such transactions of section 47. Yes. So just I just put this so that we have it again in our mind. Does 50C apply to the right to purchase a building? See here, what did they say in section 50C? Land or building or both. Suppose on agreement, you are holding a property. On GPA, you are holding a property. And you transfer that. Would 50C apply? Would 50C apply? So just any thoughts and questions?
GPA is not.
So GPA is not transfer. Okay. So in case we have got a sale agreement, I enter into a sale agreement for the purchase of one flat of a building for rupees 1 crore, and I give him 10 lakhs rupees. Right, and when I finally dispose it off, its value is higher. So 50C on what I have to pay? Would it apply? So
It is not a registered document. In Tamil Nadu, general power of attorney has to be registered within the 30 days.
okay. So I will take the example of sale agreement only because general power of attorney varies from state to state. So I will take the example of sale agreement.
Sale agreement is not a registered document.
It is not.
going to the sub-register.
Yeah, it is not going to the sub-register. However, it is an enforceable document only, legally enforceable document, as per Indian Contract Act 1872. It is a valid document. Even for that matter, a white piece of paper we write something is also enforceable document.
No, enforceable document, unless it goes to the sub-register, there cannot be guideline valid.
Unless it is transferred. Now it is being transferred. I am holding a right in a property. I am holding it and I transfer it to you without registering that property on my name. In such a case, would I be subject to 50C? So yes, there are few out of the decisions that I am asking these questions, okay? Out of the judicial pronouncements which I would share with you. It says it does not apply to the right to purchase in a building. It does not apply to right because right in a property is not equal to ownership of property. It is not ownership. It is only an enforceable right. Enforceable rights, 50C cannot be called ownership. So transfer can happen here of land and building, and rights in land and building is not added here. So specifically, because it is not, or any vested right in a property is not added in the section after the words land and building. Like had section 50C been land and building or both, or any rights in land and building or both. So therefore it does not apply. And
It's
there
applicable for the original seller and you are a middleman there.
it does not apply to us on the date of registration. On the date of registration by the second party, whoever is buying, and the seller is the same person. Then in such a case, it is a direct contract between both of them at the sub-register office. And Transfer Property Act, it squarely applies, and therefore then there is a transfer of land or building as contemplated in 50C. In such a case, it will automatically apply. It will automatically. So whoever is selling or transferring the right, would it apply was the question? It will not apply. There are pronouncements in support, so we can take shelter of those which we would be sharing. Because in one of the sections, the rights also were incorporated. I will recollect that and tell you before this end. What if one sold off a purchase agreement that was in his favor? So it is the same, apply to right, or it is the same, I worded it differently. An agreement, purchase agreement, like allotment right in a cooperative society, something like that. It is still, not totally registered. Then it is just a letter of allotment. So it doesn't, 50C does not apply because it is only a right and not ownership. Rights and ownership cannot be equated under section 50C is what is given in that pronouncement. So the various judicial pronouncements. Yeah.
But what is this leasehold right?
Leasehold right also cannot be subject to 50C. That is there. So sir, if those papers were there distributed, the printouts are there. Can you give me one copy please? Stay was not granted. That stay order came to the table wherein he pre-decided the facts of the case and almost passed it on like a judgment to reject the stay. The same grounds were adopted by the CIT appeals. Straight, verbatim reproduction. So unfortunate that CIT appeals is also being influenced by the regular administrative authorities. So forget the assessing authority. CIT appeals also, in certain cases which we faced, we feel so bad, especially with so much of demand. 4.5 crores, 90 lakhs, 20% has to be paid. It is becoming very difficult.
It is not 20%. What state appeal is 100%.
Yes. In
Correct.
fact,
State appeal say no to you.
when initially that 15% stay was introduced, the Honorable Finance Minister at the time said, if you pay 15%, now it is 20%, back then it was 15%, you pay 15%, you get automatic stay. That is what he said. He did not say if you don't pay, stay will not be given. He did not say if you don't pay, stay will not be given. Ideally, stay should be discretionary power of the assessing officer. He ought to consider the facts and circumstances of the case to grant a stay. Just since you mentioned this point, I'll add it. One case that I was handling, the assessee, they entered into a JV rather, with a builder, and they decided that they will construct a property. The property should be constructed within 3 years. So he has given certain sum of money. It should be constructed within 3 years. Whether the property is completed or not, whether you are able to sell it or not, you should give me whatever money I am giving. So X plus 50. You give, if I am giving 3 lakhs, means you have to give me back 3 lakhs plus 50, the completion of the 3 years. He said 3 crores plus 50. Okay. Now what has happened? We all know what happened to the real estate market. It crashed. So the property could not even be completed. They spoke with the builder, they said, okay, you take a little bit more time to give back the money. But the assessing officer, while considering the order, stated that it is like a finance agreement. You are guaranteed your return at the end of this 3 years. Therefore, I am bringing it to tax. Now, for the example, I quoted 3 crores, but in reality, it went into several hundreds of crores. Now, in reality, the assessee has got 0. They have given the land, it is being constructed. It is only on completion that they will get the property that they can subsequently sell to recover the consideration, or they will have the property. But in reality, the property is not even completed. It is halfway through construction. They have lost that land also because it is half constructed. They cannot get back the land. And the officer is taxing it. So, the assessing officer level, it was not considered. And subsequently, on appeal, when we went, naturally, we are going to ask for a stay. Because 30% of several hundreds of crores, it is impossible that you will have the liquidity to pay that money. But that's how the department is behaving. They said, no, it has to be done. Finally, we really escalated it to get the stay. But there is almost a blanket. I don't know how it is in commercial areas, but here, unless you pay that 20%, stay is not being given. It is not being given. Maybe if the person is friendly to you, they will hold it off till the appeal is disposed of. Till your CID appeal is disposed of. But the moment the CID appeals order is passed, 100%, as sir rightly said, 100% is due. So that is the reality. And when it comes to capital gains issue, especially liquidity issues come up, because the amounts we are dealing with runs into several lakhs or several crores. So naturally, if a stay is not granted and there is a dispute over the demand, it becomes a significant pressure on the assessee's packets, because they have to borrow to pay the tax at a very sorry state of affairs if it has to be done. Sorry, Rahul, I just wanted to add to the point that you were mentioning.
Says your inputs are very helpful. Thank you much. And just to add to that, there are a couple of cases which say that it is the discretion and the 20% did not necessarily be paid. So, and there is one circular also, which little it helps. So by the end of this, I think I will share. Yeah. One is LG Electronics India case, Vodafone India, LG Electronics India, Vodafone India, Flipkart India, and if you are noting out, I will read them, though out of context. Does anybody want those cases? Okay. Fine. The next point, number 9, is the MOU in that case, facts and circumstances of that case, it was a land. And after it was divided into parts, finally there was lesser yield of that. So in which case 50C cannot be applied because the yield was less. So this can be handy in situation where the land development is done and not being claimed as a business asset. When it is not being claimed as a stock in trade and when you are charging it to capital gains, in such a case, this little case law of the Bombay High Court can be helpful when there is partition of the land and there is layout being done, wherein hardly out of 40 square yards, which is equal to 1 acre, 2600 square yards or 2800 square yards is the real yield, and rest is left for the roads and the parks and the development. So in this doesn't apply to booking rights of flats. Point number 10, booking rights we were talking of, because it does not apply to rights, it applies only to the real actual ownership, and right in a property cannot be equated to ownership of the property is what is held in that Kolkata tribunal judgment. So failure to refer the matter under 50C2, so it was remanded back. Even at the tribunal stage also, it was remanded back to the assessing officer for valuation because he did not discharge his quasi-judicially function properly. Next, point number 13. Not in this case, there is 50C that provides of that shelter. This is a simple case, straightaway case. So another point number 13 is 1C, 271 1C, would it apply to 50C? 50C is a deeming provision, and the intent, there is always scope for the SSE to explain his intent and to explain the facts that the value which he realized in fact is not equal to the stamp duty value. So he can always have a valid point. So finally he might lose. Still he can always substantiate basing on the facts. Like for example, we were talking of the high tension wire going around, or this triangle shape which Abhishek was talking about, right? So in such a case, because there is a scope given by law for us to explain, so 1C cannot be mandatorily applied. So that is the shelter of 1C given in point number 13 by the Hyderabad Tribunal. So in the case of depreciable assets, can we apply 50C? No. Depreciable assets are the assets that are under section 28. They are the assets. So then under section 28 and 32, depreciation, after we provide depreciation, there is another section which takes care of the capital gain. What is the section that takes care of capital gain in the case of depreciable assets? 50, section 50. So 50C has no relevance to depreciable assets because there is a specific section of section 50 for that. Now 50C, can it be, point number 15, can it be invoked in respect of unregistered documents? Chennai ITIT, no. Unregistered documents, it cannot be invoked. Like for example, you are holding it on a value, an agreement, a 10 lakh property, you are holding it on, 8 lakh value. So because you are holding a right, which is disposed by somebody, that right in that property is given by somebody to you, by the seller to you, it is transferred to you. Can that be taken? No. Like how right cannot be equated with ownership, earlier we have seen the same point. Right here cannot be equated with ownership.
That means the sale, leasehold land is sold. The capital gain doesn't apply on 50C, but it may apply in other.
When the leasehold land is sold, at the time of sale, it is a transfer, and such transfer is subject to 50C. Not the transfer of rights. Once we acquire the right, stage 1. Stage 2, we dispose the right. So, acquisition of right, for that acquisition of right, section 50C does not apply.
I had a doubt here.
Yes. Yes, please.
Where there is a part performance of a contract, for example, I am selling a property for consideration. I receive the consideration, I have transferred the possession, but it has not been registered. Will that also fall under your right thing? That's what I am not able to gather.
So, part, in respect of part performance of contract, please come again.
So I think section 47, sorry, section 2, when it defines transfer, 247, it says that it includes the part performance of contract. Under section 53A of transfer. So here it specifically states that registration is a mere formality. As long as substantially whatever needs to complete that transfer has been completed. In that case, for all practical purposes, under the income tax law also, for capital gains also, it will be a transfer. Therefore, in those cases also, can we apply this section, point number 15 that you are saying? And that was just Chennai ITIT. So I'll be very happy if we get to this.
Yeah, I will send you the full text of this judgment. However, it is quoted here, so it will be easy for you. So, what in this case and in one earlier case also, which I mentioned, that transfer rights cannot be equated to ownership. In both these cases, the analogy that was drawn is ownership and part performance are not one and the same. So it is only part. So that this is one deeming fiction. So deeming fiction over deeming fiction again, that cannot happen. That is the analogy that is drawn. So that in interpretation of statutes also, that is what we see. So if your facts are similar, you can draw something out of this, then this judgment can really help you. However, what I understand is the full and final ownership is required for a deeming provision to levy tax, because finally part performance may not be discharged totally and it might even get cancelled. So for 50C application, that I think we can argue in favor of SSC.
In a case where the full consideration has been received in the previous financial year, transfer takes place in the next financial year. I think he may have to pay the tax on previous financial year.
That is a good question.
Yeah.
So, yeah.
You are saying the consideration received in the previous year.
And there is some delay in registration of the property.
So there is a sale agreement here. The date of the agreement will be because the question comes up. What is the date of transfer?
Right.
That is the question that we need to ask. What is the date of transfer? So for all practical purposes, where a substantial portion of the transfer is complete, therefore where consideration is transferred, where possession is transferred, everything is done except mere registration, then in that cases for all practical purposes the transfer is complete. Under the eyes of law, the transfer is complete. So capital gains will arise on the date you receive the consideration and the sale agreement is done. It is not the date of registration. If that is the case, nobody will register anything. They will say it is not, I'm only still registration pending, sir, not yet complete, capital gains not there, like that they will say. But registration is only a mere formality. Suppose, let's take a scenario where you have paid 80% of the consideration. Possession is not fully transferred. Possession is not fully. They can say you can go visit it whenever you want, but you cannot stay there. I will not give you entry beyond this time. You will not enter the compound beyond this time. In these sort of scenarios, you can argue that it is not a complete transaction. Even though 80% consideration is paid, some portion of possession is there. You can work on it from 9 to 5, you can do your interior and all you can do. But I will not allow you to inside that house after 5 o'clock unless you pay me the balance 20%. These sort of scenarios, it is not complete. Therefore, you can argue that it is not a part performance of contract. But where for all practical purposes you have done substantial completion, then it will be considered part performance, it will be transferred. So date of the transfer, that is an important point.
Documentation plays a role.
Documentation.
What about JDA?
JDA will be covered under section 50D, not under
Correct.
today's thing. You want to answer it or?
No, the same point. In
Yes.
fact, it is covered under 50D.
To answer your question, sir, it is the date of the completion certificate, the date it is issued by the builder is what is important for JDA. For JDA, it is not the date of construction, it is not the date of sale, it is the date of issue of completion certificate. That is, whoever is the regulating authority, they will issue a completion certificate. That will be the date of transfer in case of a JDA. So fair market value on the date of issue of the completion certificate will be taken in case of JDA. That's what section 50D also says.
Yeah. Thank you for that. And now, moving on, point number 16. The 16 is one which Abhishek was referring to, Gauli Mahadev. Yes. Cannot restrict the exemption under 54 EC without total investment also. Exemption need not be restricted to the deduction and capital gains. Investments from all sources may be considered. So this in fact can help because even other than for 50C also, for full value of consideration, wherein there are any deeming provisions, the benefit is given. Like for an example, though we deviate a little, earlier he was talking of 56.7b, which is redundant from 1/4/2019, in which place 56.10 has come up, clause 10 has come up. 56.7b, earlier it did not give the benefit of cost of indexation. 56.10 now is giving the benefit of cost of indexation. So where on one hand there is a deeming fiction and it is levying tax, the benefit is also being extended. In the case of 56.10, the cost of acquisition benefit is being given under 56.10. So here also, interpreting the intention of various sections and drawing the analogy, especially in the case of deeming taxation provisions, we can substantiate our claim with regard to the investment part, like borrowals, or you invest from your own other sources, if not from the full value of consideration, if not from consideration that you receive. Point number 70, where the SSC could prove the sale consideration, assessing authority cannot apply 50C merely basing on DVO report. So proving the sale consideration, proof, evidence, sufficient evidence, enough evidence, it is all based on facts and circumstances. So if we really have a valid case on hand, then building up of documents and various circumstances, all of them being supported by this judgment can come handy at the appellate stage. Right? Though this cannot be treated as part of law, it is just interpretation of law by the Delhi High Court. So this Delhi High Court judgment can help us. It's conversion of agricultural land. So 50C does not apply to business income because it does not apply to business assets, it applies to capital assets. So business assets are there under already chargeable under 43CA, which we will be dealing in short during today. 50C does not apply to business income. In IT Ahmedabad and the same case was had. And 50C could not be applied to leasehold rights in land. One of our colleagues were discussing on this, leasehold rights in land. It cannot be applied for IT by Mumbai. After that, you please check after this judgment if the department could succeed in further appeal, please check. Okay. Transfer of property by way of GPA is not a valid transfer. In this, the power of attorney and all, little discussion I have given. The text of the judgment, a little text has been reproduced for understanding that the rights cannot be equated with ownership. So GPA is not, transfer of property is not by way of GPA is not a valid transfer because it is only transfer of right, it is not transfer of ownership, and hence 50C does not apply. And there is another interesting judgment at point number 21. ITIT Hyderabad. It says 50C does not apply to distressed sale of land to government company. So government company is a law. In this judgment, the authority treated, the appellate authority treated the government company to be more authentic. So the evidence that we have to gather in support of our claim stands fortified by the fact that it is acquired by the government company. So that is what is there in this. And penalty under 271(1)(c) cannot be levied on other judgment which I have just put. So these are the various judgments that I've referred to for the purpose of 50C. Now, before going ahead to the second part, that is 43CA, which is just for discussion. 50C, any points to discuss?
I ask for land acquired, compulsory acquisition of land.
Compulsory acquisition of land, sir, yes.
See, government has, state government has acquired, compulsory acquired the land. It has acquired the land on a particular date. And the persons concerned, they are not received any consideration. They went on appeal to the court. First, sub-court has given some value. They went on again on appeal to High Court. Madras High Court has given additional compensation, and additional compensation was paid, and 3 days was rented and remitted. What is the date of acquisition to be taken? What is the fair market value to be taken for this purpose? 3 dates are there. But money was received only after the High Court compensation. High Court order was passed, and it was paid during a assessment at 1990.
So before Abhishek answers, I think the date of transfer has to be taken, because at the time of transfer is what is there in 50C. So it is not payment of consideration date, it is not further payment of consideration date that is contemplated in 50C.
Compensation, actual compensation received date has to be.
So there are, to add to what Rahul said, when it comes to compulsory acquisition, there are usually two parts. There are two parts. The first part is the date of transfer. So what is the consideration due or receivable? Something will be due. Maybe they haven't remitted it to you, but something is due to you. So whatever consideration initially the government or whoever is the acquiring authority, whatever they fixed, that will be your capital gains on the date of transfer. So you'll set it off against your cost of acquisitions, net to capital gains, capital loss, whatever you will have.
But
Now,
they deducted tax and paid TDS, all these things only during the when the High Court order was finally passed, compensation was paid. Till then, no compensation was paid or received.
but you should have, as per the agreement, something, no sir?
There is no agreement.
Or as per whatever order they are passing for a compulsory acquisition.
They pass the award.
Yes.
They generally pass the award saying that this is I am acquiring your land and this is the.
Usually they take guideline value and they'll fix that as the compensation.
Yes, yes.
Now what will happen is this, whatever is fixed as per guideline value, as per the order, you will take that as your capital gains for sale consideration you will take on the date of transfer, on the date of acquisition. Now
First date.
First date. Subsequently you get an enhanced compensation. Maybe at the time of enhanced compensation only you are getting original consideration. That is separate. That already has been taxed. You should have paid the taxes what the Act says. Maybe you should go for a stay or something in those situations. But the date the appellate authority or High Court or Supreme Court, whatever order they are passing with an enhanced compensation, on that date, on that year, the enhanced compensation becomes taxable. So your entire enhanced compensation will be your sale consideration. Cost of acquisition will be zero. And that will be your capital gains. That will be your capital gains.
Section 119 will apply for it.
pension on one end. That is how it is. So you will have twice in capital gains itself.
And how to claim TDS on that case? Refund, sir.
Yes,
How to
ideally.
claim?
Year in which it is deducted.
The year in which it is deducted only
No,
ideally.
no. See, they are comparing with the amount what you have received, no?
Yeah. So there is, regarding this, there is a clarification, I think, if not a circular. I am not sure whether it is circular or clarification issued by the department that income and TDS need not match. That happens in many cases.
In
Income.
every case also, sir, income is tax credit. As a 26 says, whatever credit you are having, your order is passed based on the tax credit.
Suppose if it is accrual land, it is tax.
Suppose, sir, it is not your income of this year. You have disclosed it an income as the next year. You might be following some cash basis of accounting, or you might be following some other basis. The person who deducts tax would be following some other basis of accounting. Or he files his TDS return only showing it in March, whereas we think that the bill has to be passed, especially in the case of contractors it happened. In our place where few such situations came up, that is why I know these situations.
Bank audits.
Bank audits. Yeah. So what happens is we think that we put up a bill to the government, though we don't put up a bill, we ask for the certification of the work done by March, which they would do in April, May. Sometimes they would do it antedated, and we never know. And we have to file the return by July, and they would have filed their TDS return or revised their TDS return, because of which it might affect our 26 years. So there is nothing that we can really do. And one in this clarification is, the income and the TDS need not necessarily match.
CPC is not bothered about those things. They are simply sending 143 1A correction.
Yes, that is true, sir. But that is one way of looking up. Another way is an opportunity for us.
So we can move on to the next part. Yeah. So 43 CA is more or less the same. There is nothing there to see actually. It is there in the paper that is given to you, and the points of discussion are also there in the paper. So 43 CA, I just drew a comparison between 50 CA. Having gone through 50 CA, again 43 CA, the entire text, it is not required, because most of the provisions are similar, except for the fact that one deals with the capital asset and the other deals with business asset. Now we know that the charging section of capital gain starts at 45 and until I think 44 AD. It is in business or profession head. So 50C, it is applicable to transferor, and 43CA, it is easy to understand. Both are applicable to transferors only. Both are deeming fictions only. Both are applicable to all SSCs. 43CA and this both are applicable. However, the applicable date is different. That is because what happened was, after 50C came into existence, knowledgeable people began to plan out for not treating it as a capital asset and treating it as a business asset. So once you reclassify it from fixed assets to current assets, then it becomes a business asset. That is the only method in which you can show in your books of accounts that you want to treat it as a business asset. And they were avoiding the impact of 50C, and it took almost 11 years for the department to realize or give us the benefit. They gave us the benefit for 11 years for that tax planning, and later on in 2014 this has been brought. So 50C, 43CA, they are almost the same. Land and building, both of which are capital assets. So this is one very important point of distinction. You can just mark, tick mark it or star mark it. Land or building or both is what is defined in 50C, whereas 43CA, land or building or both, which are not capital assets. So under 50C, what are land building that are capital assets, and under 43CA, those that are not capital assets are defined, because capital assets, they cannot fall under section 28 charging. Right? They cannot fall under business or profession. They cannot be capital assets. They can only be trading assets. Means this includes flats, plots, rural or urban agricultural lands that are not capital assets, industrial buildings, cold storages we have seen. All these which are either treated as plant and machinery or treated as civil civil works that are liable to depreciation under section 22 on which we are claiming 32 depreciation. So this is the major difference between these two sections, that capital assets are taxed, land and building capital assets are under 50C, land and building which are not capital assets are under 43CA. Now for the purpose of section 48, the fair value of consideration 50C is a deeming provision for 48, and this is a deeming provision for computing section 28 profits and gains, the charging sections. 1/4/2019 105%, 1/4/2019 same 105%. That little benefit or leverage of 5% is given with effect from 1/4/2019. So I need not explain that again. Right? It is the same benefit. It is nothing but copy paste of section 50C only. The entire, most of it. Agreement, here also agreement plus other than cash money receipt. Here also agreement plus other than cash money receipt. Means that if there is a trading asset, if there is a business asset, and you have entered into an agreement for the sale of the business asset, on which you received through any of those three modes, you received an advance money, and after which the stamp valuation increased from 10 lakhs to 15 lakhs, say. In that case, if you have got, the evidence of the payment and the evidence of the agreement, then you can take shelter under the proviso. Here also 43CA there is a proviso, similar proviso as is there in section 50C. Hope you are able to understand. Now 2 points here. One point is the cash money receipt, we already explained that. Another point is agreement. Now an agreement, should it be in writing or is oral agreement sufficient? That is one point. For trading, usually it is done like, I'm booking, I'm earmarking plot number, 304 for you, something like that, or flat number 312 for you, something like that. Initially, that is how it is done. So in the meanwhile, and if that is done in June and July 1st, usually the stamp rates increase and the stamp duty rates increase. Then what is the effect if there is an advance, right? So in such a case, then it is advisable that even if verbally you agreed or there is a oral agreement. Oral agreement is binding as per the Indian Contract Act 1872. It is a legally enforceable agreement. Still, if it is put in writing antedated, it would be good to avoid the effect of 43CA. The word transfer is used under section 50C. Under section 50C, the word transfer is used. The definition of transfer. The definition of transfer in 247, it is given as transfer, it begins like this. Transfer means, transfer in relation to a capital asset means. So for the purpose of 50C, transfer definition talks about transfer of capital asset only. Now here in 43CA, the word transfer is used. And transfer, if we go to 247 definition, transfer, it says transfer in relation to capital assets. Under 43CA capital asset, it is not applicable. So can we adopt, for the purpose of 43A, can we adopt the definition of 247 transfer definition? No, we cannot adopt. That is because in 247 transfer in relation to capital asset is used. In relation to capital asset means 50CA, 43CA is not a capital asset. Because here this section talks of liability on deeming fiction applies on any other than capital asset only. So that way, transfer, the word transfer of 247 cannot be adopted for 43CA. Okay. Now, the question arises, is the word transfer defined for the purpose of section 43CA? No, it is not defined under this law. When it is not defined under this law, from where do we have to adopt the meaning of the word transfer? Section 5 of Transfer of Immovable Property Act. However, in one judgment, which I think I have shared with you or I will share with you, it is said that Section 5 of Transfer of Immovable Property Act does not apply to 43 CA. That is what they said, which means that for this transfer, when Immovable Property Act is not applying, when Transfer of Immovable Property Act is not applying, even an allotment letter or a receipt or an agreement can be considered to be transfer for the purpose of 43 CA. So this is a huge variation from what all we understood under 50 CA. Huge difference. So because transfer means a transfer as is understood. It can be transfer of control, as I was talking earlier, transfer of possession, most of the contract being fulfilled, performed, or an allotment letter being issued by any board or the housing society or some development authority, that can be a transfer. So a right is also deemed to be transfer, like what he was talking about earlier. So here transfer means general interpretation of transfer, which is wide open to any sort of interpretation because it is not defined under this law. Okay. So now we will just go through the last page, that is various situations. What is the meaning of transfer under 43 CA? The meaning of transfer, we understood what is the meaning, what is the definition. The question is not what is the definition, what is the meaning. Definition means it is defined in this law. Meaning means our general interpretation. As per our interpretation, transfer means, it can be possession, it can be control, it can be custody, it can be allotment letter, it can be transfer of right by a paper or any document, it can be anything. So manner of applicability of provision of 43A when a real estate developer applies percentage of completion for revenue recognition. Now for a while, dear colleagues, for a while we have to come out of that 50C mode and now get back into business, profits and gains for business. Now we have to get back into P&L account mode, right? P&L account, our expenditure and our income. Now for this clause, part performance, for this percentage completion method is mandatory for service contracts. 43 CB is there for service contracts or construction contracts. It is mandatory. And now percentage completion method is mandatory even under ICDS. Percentage completion method only has to be followed. Now when there is so much of importance for this percentage completion method and guidance note on the real estate transactions which is issued by our institute, I think it is applicable from 1/4/2014 or something, 2013. Guidance note by our institute also makes it mandatory that percentage completion method has to be followed in accounting. Guidance note is for accounting, it is not for taxation. So going by all this, the percentage completion method has to be followed is the point, is the conclusion. Now, how do we deal with when percentage completion method is happening? It takes 4 years, for example, for a business asset to get transferred, to get constructed, a building to get constructed, independent house and get transferred. Year 1, basing on percentage completion, we recognize some revenue in our books. Yes? Second year also, we recognize some revenue. Third year, we recognize. Fourth year, there is transfer. Fourth year. Now in such a case, actually what is transferred during these 4 years money, 4 years is only 1 crore of rupees. Now when we are following the percentage completion method in our books, our revenue in the P&L account was taxed in bits and pieces over the 4 years. Now if we apply 43 CA, then it is going to tax something more than what is already offered to tax. So that this is a very tough situation, very critical one situation. Now I think anybody can. Pardon, sir? How to determine cost is there in those we can understand from. Sir, a percentage completion method, you see, cost and income matching, cost and revenue matching is what is there in that. That is all accounting treatment. How to account for the cost and all, that is all in accounts. Now as far as taxation is concerned, we are talking of the consideration here, full value of consideration for the purpose of 43 CA. Okay, for this purpose, when there is percentage of completion method being followed, it is very difficult to apply 43 CA for percentage of completion method.
43 CA will be applied only when there is a transfer. As far as tax.
Only when there is a transfer. Transfer of what? It is not 247 transfer, no.
Yes, correct.
So transfer can be the day one allotment letter, day one agreement letter. It can be the date of agreement also. So transfer can be any date.
Yeah, but on that, where is the question of applying 43 CA?
Sir, first year, second year, third year, fourth year, we agreed to pay, over the construction, we agreed to pay 50 lakhs.
Yeah, the
Right?
agreement of
And finally, at the time of registration, it was not 50 lakhs, it became 60 lakhs. So what do we have to do? So do we have to pay tax? We accounted for 12 equally, let us assume, all 4 years. Now on 10 lakhs do we have to pay? That is the question. Additional 10 lakhs. Now if the registration value is 60 lakhs. So registration value.
Technically, how it is getting addressed, here we'll make the guidance value, the undivided share allowed will be going for registration. And another one is the concession agreement. For that also the registration, a small stamp duty has to be paid now. Normally what they will do is, they will fix the value. Suppose this value is going up, they will reduce the value from the construction cost, construction pricing. That is how it is getting managed. Otherwise it's manageable as of now.
I did not understand that point.
No, see
No,
here
the
how
value
How
fixed.
can you understand?
No, I will try to do it again.
Yes, sir.
I will explain again. See here, all these developers, what they will do is, they will register the undivided share of land. And
Correct.
UDS they call. Afterwards, there will be one more another agreement for construction. Construction agreement is separate and UDS is separate.
Okay.
Predominantly our 43 is going to applicable only on the registration part of the land, okay, which is my UDS only. Okay, if it is going up, okay, I will be getting it adjusted if my overall price is fixed for the flat. And that will get adjusted by construction agreement.
So we are not talking of increase in consideration, sir. We are talking of increase in fair
How we
market
are
value.
going to comply with 43 CA, that is what I am trying to say.
That is a huge challenge, sir. That is the point.
No, I am telling you how the challenge can be addressed. Yeah, that's a challenge.
This question is there, when it is not sold, only after completion of after the 4 years, it is kept as ignorant.
That is true, that is true.
Your question is that the first itself I have sold.
No,
So I have
even
to
UDS you
register
are going to register at the back end, assume for a moment, okay, and UDS along with your construction agreement, both put together is your cost of the property, right? Now if it is going up, so the cost of the property has been fixed. So as far as construction agreement is concerned, there is no role of 43 CA, that is my understanding.
So after understanding this, I've gone through various articles written by many people, because judgments I could not find in 43 CA because this is relatively new, and the department I don't know, even department also knows about this really. So with all respect to the department, sir, the conclusion that many articles and many thinkers who are giving on this is that the transfer happens only in the end. It does not happen earlier. So you can account for it in any way, right? And the transfer is there at the end only. So when you register the property only, then only you treat it as transfer. Until then, 43 CA will not apply. Is what is the analogy given by many people across. And in such a case, this date of agreement value versus date of registration transfer value being backed by many number of payments that are made through those 3 methods, we can take the shelter of that. Like 50 C only, we can take the shelter of that. However, it is practically to calculate it is very difficult if the department says that transfer does not mean transfer under Transfer of Immovable Property Act only. For this, as we were understanding the definition, the meaning of transfer. Transfer means possession also. It is not complete. Still, it is under your control only. Still, you are coming and doing what you want to do, interior and all. Every day you are coming and doing. If it says, then that will be a huge challenge, because there were no citations that I could find. I am unable to throw any light of the judicial pronouncements. But still I feel transfer is not a transfer under the Movable Property Act, might be contended by the department, and this is certainly open to risk. And when a person really has to pay, when a business person, realtor, has to really pay tax on the higher amount, then it becomes a huge challenge for him also, because he will have to saddle that tax portion onto us as well.
Total value. Total value. No, total value.
No, total value, sir. That is a composite agreement. You cannot construct a building without the land. That is why you are buying the land. Broadly, that is how you have to understand. Though they are registered in bits and pieces, still it is registered because it has to be on your name. It is not that, plots are sold. Whoever wants construction, only for them it is being constructed. No, it is not the case.
These are flats.
Flats also, any case for that matter. It is a composite agreement which is being registered in parts. The performance is being done by under transfer of Immovable Property Act in parts. The performance. It is not that this is an independent transaction, that is an independent transaction. No. That does not happen in the case of builder. In the case of person who is a realtor who wants to sell who is only into selling of land, that only happens. Whether effect of 43 CA is to be given in books of accounts. Whether should we record in books of accounts? Pardon, sir? Yes. Sir, ICDS we are going to recognize based on percentage completion method only. That is recommended. In which case, we have to contend, as I just said, we have to contend that the transfer is complete only when, it is registered. So judgments have to come up on that, sir. So I'm sharing both sides, whatever I could gather, I'm sharing on that, because it is not conclusive. This section, because the word transfer is not defined, it is leaving open, for many things. Now, percentage completion ICDS is for accounting. So whatever is there in accounts need not necessarily be in the statement of total income. So that is one perspective to this solution.
But ICT is again for the purpose of taxation.
Taxation only, correct.
Okay.
Yes, correct, sir. Taxation only, correct. So builder makes an agreement for sale in newly launched project, a price of rupees 5 lakhs, market price is 7 lakhs. Subsequently, the market price on that date is, because it is a newly launched product, he is selling it at lesser than the price. Subsequently, investor, he cancels the deal and settles the deal for 7 lakhs. And he takes the difference of 2 lakhs. Whether provisions of 43 CA will apply.
43 is for SRO, it's for market.
Yeah, correct. Here also. That is what is agreed upon.
Probably 43.5 may come. It is as good as speculation, not taking delivery. You've given money and again selling it on lighter side.
Again selling. So, yeah, could be. So this is one question. I just put what few questions occurred to my mind, and I just put that it could have been. However, since he is cancelling the deal even before the registration, the question of its application will not arise. That is my opinion. What would be the situation if the investor cancels the deal and settles for the same amount of rupees 5 lakhs? Then 43 CA would it apply? Naturally, if it is 7 lakhs, and even if they settle for 5 lakhs also, still it has to be applied. Because it is lesser than the market value. Next point. If a builder sells the right in flat before construction is completed, would 43 CA apply? Before construction, if he sells the right in flat. Yes, here transfer means not just of the building but also of the right, because transfer word is not defined. So will 43 CA be attracted? In my opinion, yes, it will be attracted. So on this point alone, it stands. My opinion, or rather my interpretation stands distinctly different from 50C 50C understanding of this of a similar situation. If a buyer has already shown possession of property long back, we were talking of this situation, and builder has also shown in his return in the previous years. Now, would 43 CA have to be applied? See, buyer has recorded, seller has recorded. Seller has recorded the advance money and buyer has recorded, has shown it as income. Now, in this year, should it be shown? Would 43 CA get attracted? That is the question. AO, should he go to the previous years and do the reassessment of the previous years, because it is transfer in those years? That is the question. Pardon, sir. Yeah, that is the question. Yes, correct, sir. I think in my opinion, when it is getting registered, we take the proviso. We take the shelter of the proviso that we have given it in advance. Though we have taken possession, since transfer is not completed and we want to claim transfer to be the date of registration only, and we claim under 43 CA, we claim the benefit of the proviso. That is my opinion on that. This entire 43 CA revolves around the interpretation of transfer, when it is deemed to be transferred. So what would be the tax effect of 2021? 2021, we pay on the agreed amount only. We pay on the agreed amount only, and the assessing authority will assess on SRO value only. And we ask them for reference to the valuation officer. Valuation officer would value basing on the circumstances when the agreement was entered into, what was the value, and the current value also he would take into consideration. We may not succeed at the AO stage, but at the appellate stage there are chances. If we can satisfactorily prove with the evidences that we bought it at the real price and that was the actual consideration, and we took possession, we took the electricity bills on our name, we took few of the municipal taxes on our name and stuff, we took the possession long back. So such evidences can come handy to support our case. So in case of sale of agricultural land beyond the specified limits, would the provision of 43 CA applicable for rural agricultural lands? Would the 2 km, 6 km, 8 km beyond, would it be applicable? Would 43 CA be applicable to rural agricultural land? Yes, it would be applicable if it is a business asset and you do business on that rural agricultural land. You sell the same as capital asset. No, it is not. It is not land and building. That is taxable. That is not capital asset. That is excluded from definition of capital asset. But here, if you do, it need not be a capital asset. Under 43 CA, it need not be a capital asset. The asset that you are dealing in is a business asset. That business asset is always liable to tax under 43 CA. So, I just wrote claiming of bad debts. No, I just mentioned that point, that's all. You can just think of claiming the bad debts. Just think of that situation. I can't explain more. That is only that has come to mind.
Somebody offered us an income, then only can go for that.
Yeah, correct. So offer it as income and then claim bad debts. I am here to educate law only, not to give few things like this. So this
Conversations can be kept after
off the record. Yeah. And off the record, like how it happens in Parliament also, please don't take it on record. In case of development agreement, what would be the incidence of tax in case of development agreement? The case of development agreement, like 54D joint development agreement, that is there.
For the builder, it is a 43 CA.
Correct. So this comes to, the percentage of completion method only it boils down to, because we have to follow that. And in percentage of completion method, we were just talking on, again, the value of the stamp duty increasing after 3 years or 4 years by the time you transfer or physically hand over the asset after it is completed. So what would be the incidence of tax? Incident of tax we discussed, and so we take the shelter of the proviso only, that is my understanding. We take the shelter of proviso because until the end the transfer was not made, and under this section we do not for our benefit we should not consider the transfer to be by any other mode. It has to be by registration only. If we can claim like that, then only the proviso benefit can be taken. However, that will depend on the facts and circumstances and how well we are able to convince the assessing authority. Because on this point alone, on the word transfer under this section alone, I could not find any judgments. If it is to the knowledge of somebody, please share. I was rigorously, searching for the definition of transfer for the purpose of this section, and also for any case laws where it is going to come. Yes, it is going to come. Whether the agreement made at the time of fixing the consideration should be subject to stamp duty, notarized agreement, simple agreement. Just in case we consider transfer to be, simple agreement also is transfer. Then should it be on white paper? Should it be stamped? Should it be notarized? Should it be registered? Which is valid? Any agreement is valid. For the purpose of execution, for the purpose of Indian Contract Act, legally enforceable, anything is valid. Now for this also, basing on any simple agreement only, even though unregistered, basing on simple agreement only, the rest of the performances are done. The agreement is registered only in cases, mostly when they go for bank loans. When they do not go for bank loans, mostly the simple agreement, that is agreement to sell, it is not registered. At least in most places it is not registered. Here they may be following system, so in big towns and cities, in big cities, it will be registered because people want to safeguard themselves. In official places, usually that agreement, they don't want to shell off that stamp duty also, so they wouldn't register it. So the same point again, 43 CA subsection 3, 4 are applicable in the following cases. Letter of allotment is issued, receipts containing for amount received. So receipts are issued and letter of allotment is issued. Because there is no definition for this word transfer, letter of allotment and receipts can be considered to be transferred by the department. So if it is considered as transfer, then that is the date of transfer. So this entire 43 CA, the various situations that I could assume, and the interpretation revolves totally around when transfer is effected. Because the income from profits and gains is when the transfer is effected, then only income, subject to that percentage completion. So these are the various points relating to this. 43 CA, it is only open to discussion. Many conclusions are not there in this, especially because of transfer and because of percentage completion method, both the complications that are involved. So with this, anything to discuss, and then we can go? Or
when the income tax officer will invoke 43 CA for the builder?
Either 50C or 43 CA, both can be invoked only during the course of assessment. Without assessment, nothing can be done by the assessing authority.
Because for 43 CA,
Transfer should take place, yes, correct. Whatever we account, we just file the return. You file the return, percentage completion, whatever you think is right.
Exactly.
You think 20% is completed, sir, the person in the last, you think 20% is completed, then okay. He says 30% is completed, then okay.
Yeah.
We adopt that percentage subject to, our convenience and situations also
Deferment
sometimes.
also.
Deferment also sometimes happen, though we can plan for it. So
Exactly.
However, 43 CA, that discussion will come, and 50 CA discussion will come only during the course of assessment. Otherwise, it cannot come.
Then they will take a block of assessments. all the 4 years or 3 years, whenever you are.
No, only 148 may be issued. Regular scrutiny, then okay, or 148 may be issued, that's all. Or 263 maximum. Okay.
Point number 11 of this 50C.
Yes, sir.
Can an AO pass an order with the value lesser than that negative material?
No, AO will not pass a value. He would not do something that is against law. Something lesser than guideline value, he will not pass until a valuation officer gives. Until a valuation officer gives, he will not pass on his own. Valuation officer gives also, still we are very lucky if he accepts the valuation officer report.
Without referring to the valuation of it.
No way. He is not competent to decide on the value of any property. He is not an engineer. He cannot do it, will not do it. Out of jurisdiction.
Under 50C2B, I am already applying to the stamp value of 30 for appeal on the reduction of the stamp prices at the time of issuing the agreement. Whether the assessing officer can refer it to the district valuation officer.
So you are applying?
Yeah, at the time of registering the property itself, I apply under 49A.
Yeah, he is bound to refer it.
No, you can read.
Right, correct. Your point is, you feel at the time of registration you paid more stamp duty and you go on and appeal then.
Yeah.
For which this is a case. Yeah, correct. That is an exception that is provided. The value so adopted by the stamp has not been disputed. So where it is not disputed, before the AO is clause number 1. Before the AO, when he asks for the valuation officer. Or otherwise, whether it is already, if it is not disputed, then again he can refer. However, when it is disputed and it is still in appeal, then he cannot refer, pending that.
Disputed before the stamp valuing authority at the time of registration.
Okay.
And he has decided a value less than the stamp duty but above than the transaction value.
Okay.
So now whether the assessing officer saying that it is below the guideline value, again can it...
No, when the stamp assessing authority, when the stamp duty authority decides a value, that value is final.
It's the end of it.
That is the, no, the question will not arise because that is the guideline value. That becomes the guideline value.
No, again there is a dispute between my transaction value and the stamp duty value.
That is outside. However, see the section, even the charging itself 53, what it says for the purpose of payment of stamp duty, whatever is the stamp valuation. For the purpose of payment of stamp duty, what is the valuation? Though under dispute, though finally given under dispute, what is the valuation? That valuation only you have to take for 50C. So the question of valuing it again will not arise by the AO because the valuation authority registration department only gave this value. Right. However, if it is under dispute, already under dispute, then he will not refer. That's all.
Addition to value by 50C and taxation under 56(2) does not amount to double taxation.
Sir, it will not amount to double taxation. It will not amount for various reasons. One is, though the property is the same, that is what the country, though the property is the same, there are two independent transactions. And this is a deeming fiction under one charging section, that is a deeming fiction under another charging section. It might appear that it is taxed, however it is taxed in the hands of two people. Like for example, I can relate it to even GST also. When one person pays tax, and we do not have an invoice, he still pays tax, and we still have to pay tax, right? So it cannot be called double tax.
Dividend
Tax.
distribution.
Huh? Dividend distribution tax also.
Now STT also is
Yeah, STT also. So there are such situations. It is taxed in the hands of two people. Double taxation is one person being taxed twice.
Nature of income getting taxed by...
Nature of income, it is not. It is a separate deeming fiction.
I think the nature also is different, sir, in the case.
Yes.
That's what the department takes.
Double-edged sword.
It's a double-edged sword, like sir said. Unfortunately, the taxation is one aspect of it. The practical aspect we have to think of where liquidity issue. If I'm going to spend so much money to buy a property, suddenly notionally I'm taxed on some other value. Whether I actually have the funds to pay the tax on that, 30% tax on that. That is a question that needs to be asked largely. Multiple representations we have already made on this point. We hope it will be considered positively. But as it stands, logically it looks like a double taxation, but it is not a double taxation. It is a taxation of different transfers, different transactions on the same property. That is what they are trying to state.
So any more, or we can?
Any more questions?
Sir, can you be a little louder?
It is not amount to unjust enrichment as what the government has in the constitution.
Sir, that is see, we are here to explain law, not contest on jurisdictional validity. Sir.
There are multiple bigger aspects where there are unjust enrichment also, sir. The way many actions are taken unilaterally, sometimes it feels that way. But legally, as sir said, jurisdictionally, they can tax. The taxation can be done. If you take dividend distribution tax, the logic was that the dividend distribution tax is paid by the company. Assessee doesn't have to pay. Similarly, security transaction tax, when it was initially initiated, the finance minister at the time, and the budget itself, he said that we are bringing this so that assessee does not have to pay tax. Security transaction tax has been brought. But today we know beyond 1 lakh, it is being taxed. So there is actual double taxation. In this case, maybe some benefit you are getting, because you cannot say double taxation as you are taking the benefit of the increased value as a cost of acquisition. First you suffer, then if you want to sell, you take the benefit. I might want to live permanently also in that house. No, but you still have to pay. That is what department is saying. So,
black money they are doing this.
yes.
Sir, and the point double taxation is related to the same person, being taxed twice. Double taxation, what does it mean? It means the same income being taxed twice. Here it is not the same income. This income is under 45, that income is under 56. It is not the same income.
Yeah.
Unfortunately.
Beyond 50C, I can ask.
Sir, beyond, sir, let us just restrict
You
ourselves.
can have that question.
Maybe after the session.
Yes, that's it. So,
Any other questions, sir? I think we can wind up with this.
Same what he has asked at the time of registration, there is one position is there. If he is not agreeing with the guideline value of the SRO, he can make an application, a form is there. He need not withdraw the document. That will be sorted out in 3 or 4 months. There is higher authority is there. At that time we get say 20% discount in the guideline value, which government itself gives us. And again that value we can consider for our IT.
correct, sir. That is what when I said, sir. That is what I said. That becomes the final value, because as is decided by the stamp authority. The stamp valuation authority is the same, whether on higher authority or lower authority, it is the same. It is the stamp authority. 50C stamp authority. So with this, I hand over the floor back to Abhishek. And thank you so much.
Sir, we'll keep the question to after the session privately. We can ask the speaker. And thank you so much, Rahul, for taking time out of a busy schedule to go on a very threadbare analysis of 50CA and 43CA. In fact, giving a list of judgments is very useful. I'm sure it will be very appreciated by everyone here and may be circulated. And once again, I thank Rahul. I request a very huge round of applause for his wonderful presentation and taking time to come all the way from Rajahmundry. In fact, he has been travelling back to back over the last 4 days. I still requested him, you must come and address our members in a very soft-spoken manner. He has taken through in a very, very comprehensive way. Thank you so much. We will be planning more programs of such practical nature which will impact practitioners and assessees. So you will be intimated of the future programs. We have also fixed the regional conference date. It's going to be happening in Kochi this time. It will be happening on 29th and 30th of November. 29th and 30th of November. So anyone who is planning can plan accordingly now itself. That is the reason. So with this, we'd like to wind up the session. Thank you so much for attending today and joining. Thank you all very much.